Welcome back to Greenomics, a podcast from Oxford Economics where we delve into the complex relationships between climate, nature, and our global economy. I'm Sarah Nelson, and today we'll be discussing how retail investors feel about sustainability. Retail investors, so that's people like you and me, rather than the big institutional investors like pension funds, we buy stocks or bonds according to our investment preferences. So we usually have preferences over risks and, of course, returns. But increasingly, attention is turning to how we think about the green credentials of our investments. Joining me to discuss this are Andre Gill, a professor of corporate finance at Gutenberg University Mainz, and Johan Neuhoff, director of economic consulting here at Oxford Economics. Welcome to you both, and thanks for coming on the show.
Very happy to be there.
Happy to.
Now, I know that you've just wrapped up a really interesting piece of work on investor preferences. Before we get into the nitty-gritty, Johanna, can you just tell me what is sustainable investing?
So I can give you the definition that the Sustainable Finance Disclosure Regulation puts onto a sustainable investment. That is, an investment needs to contribute to an environmental and social objective, and it does not significantly harm an environmental or social objective. And moreover, the investee companies are to follow good practices in respect to management structures, employee relations, remuneration of staff, and so on. So in short, it's really about any investment into a economic activity that supports environmental and social objectives, as well as the company needs to follow good governance. And our project really focused on environmental sustainability, and the experiment that the university did concentrated really on climate finance. So one part of this sustainable investment definition.
Thank you. That's really helpful. So, Andre, maybe can you please tell us more about this experiment into sort of that climate investment preferences that you've been running, please?
Sure. Very happy to do so. Let me basically start by saying that when we are talking about an experiment, right, then this kind of experiments are not the experiments that many of the listeners may have in mind, that we are in a lab, right, and we basically have some chemicals going on. But these experiments that we have in mind basically is understanding in a very controlled environment what people are actually doing. Okay, so this entire experiment was designed to better understand how the individual investors, as you were referring to it, right, not the big pension funds, but also what we often call the household side, right? So the individual investors, how they make their decision about sustainable investments. And one of the key challenges in designing, but then also in understanding this question, right, is the difference between what we say are stated and revealed preferences, right? So it's a big difference if we ask people whether they want to invest sustainably or whether we are able to observe how they actually invest when real money is at stake. So to tackle this, we used a behavioral experiment where participants were actually giving a budget and then asked to allocate it between a conventional and a sustainable financial product. And to be able to carve out a little bit what their real incentives are, we exogenously varied the expected return of the investments. So to see whether people actually react to prices or whether they have like true standing, deep preferences either to invest sustainably or not sustainably, regardless of, say, the expected returns.
Thank you. That's so interesting. I feel like that stated and revealed preferences, it's like, putting your money where your mouth is.
Yes.
In a lab or in whatever environment you're in. That's really fascinating. So what did you find then?
So let me really emphasize this. Very many studies that are out there often look at, say, average behavior of people. right? But what we really found is that, and this is something that I think cannot emphasize enough, that we know that people are different, right? But let's also look at people being different with regard to their investment behavior when it comes to sustainable investments, right? So what we find is, and we used some, say, more or less fancy machine learning technique on this, right? We could classify investor types into, if you want to put it very, very, say, roughly, into 4 different types, right? So the one would basically be someone who, regardless of the return, somehow invests 50-50, right? About 50% in the sustainable investments, about 50% in the non-sustainable one. People, we would then call them diversifiers, maybe, right? Then we have some portion of participants who invest nothing to very little into the sustainable one, also regardless of the price, right? So people, we would maybe call them skeptics, right? Because they, no matter how good the return of the sustainable investment actually is, they just stay with the non-sustainable investment one. Then we do have the ones that some would call them advocates, right? They, regardless of the price, even if the return of the sustainable one is lower than the one on the non-sustainable, they, regardless of the price, invest nearly everything into the sustainable investments. And then we have those that would, like the very classical finance 101 theory would suggest, right? People do not have any sustainability preferences, right? They just react to prices. And do we see these people? Yes, of course we do see these people, right? So they invest near to zero into the sustainable one if the non-sustainable grants them higher returns, and vice versa. So they heavily react upon the price, right? So these are like 4 more or less distinct types that we could get from this, and this is the important one, from this individual data that we gathered through these incentivized experiments.
And did you find that there was, I mean, did you do the sort of stated preference stuff as well? So did you find a difference between people's stated and revealed preferences through this experiment?
I mean, I may combine this with other stuff that we already have been doing, right? A couple of years ago, or still ongoing other projects, right? Where we do see, again, it's not a clear-cut answer, right? So for some people, we do observe that they state they want to invest heavily sustainable, but if you then put them into the environment that they actually need to invest their own money, they withdraw from that, right? So I find it super hard to say, no, there are definitely, this is just all green, individual greenwashing, right? But do we observe individual greenwashing? Yes, for sure we observe it, right? So there is a bunch of people who actually tell you that they want to invest sustainably, but then if they actually need to do it, they do not, right? And the key challenge, I would think, both research-wise and policy and, say, consultancy-wise, is to disentangle this and come up with measures how we can actually have an understanding who are the people who actually invest sustainable, want to invest this sustainable, and are actually also maybe willing to pay a higher price for investing sustainable. So really have these, say, green preferences, if you want to call it like that.
Thank you. So your study, which was testing that kind of, what people really do in this environment, you found these 4 different types of investors, or archetypes maybe of investors. Did you do any correlations between their demographics or other features and those preferences?
Sure, but if you look at these kind of experiments, right? So it's the one thing that we have these, say, incentivized experiments, but for sure, while doing this, we also run like big surveys alongside, right? So with the same people, right? Asking them on their demographics, on their, say, political opinions, all of these things, right? So the stated ones. right? And what we find is, yes, we do find that demographics play a role, right? I wouldn't overemphasize this, right? Because these are now, say, the descriptives behind these 4 types, right? But what we find is that, for example, the diversifiers tend to be a bit younger, right? And tend to have a lower financial literacy compared to other groups. So it may be the fact, right, that these people who have a 50-50 split, more or less, may also be the people that we may want to educate, right? Then we have the older investors, particularly those who are already retired, are the ones that actually are the most maximizers. So they react to the prices a lot. They have a high financial and environmental knowledge, but it seems to be that they are only willing to invest sustainably if the returns are competitive, so to say. When it comes to, say, the skeptics, what we see, they tend or needs to be really, really cautious on that, because some of these ones are not statistically significant, but they tend to be having lower financial literacy, but paradoxically a higher awareness of ESG products. So there's also much more that we need to dig in. And then when we talk about, say, the advocates that nearly invest everything into the sustainable product, there we see something that we could also expect maybe, right? But it's good to have this supported, is that they support strongly, say, government interventions, for example, in climate policy, right? So these are, say, a rough idea on some of the interesting demographical correlations that we find. Last but not least, in, let's say, more or less interestingly or surprisingly a bit, right, many studies find or show that women invest more sustainably than men. We actually do not find this in our sample, okay? Which I don't think is like the most interesting one here, right? But it's a nice idea that also there, just having maybe a gender split, maybe not enough to understand how people actually invest on markets.
That is really interesting, because I've heard that sort of split of the sort of women having stronger green preferences in terms of investing. But I was going to ask you if there was anything from the results that really surprised you, but maybe that was it. Was there anything else that kind of went against the sort of experience you've had in previous studies?
Yeah. So the interesting one is that we also ask whether investors are willing to put money on the table to gather sustainability information, right? And we actually find they are, but despite this willingness, the additional information did not really influence their final investment decision, right? And then if I may combine this with other research that we have been doing, right, there we entirely focused on the role information play in the individual decisions. And there we see once this information actually is revealing information about the expected return, then it again can shift the, say, propensity on how people are actually willing to invest sustainably. And maybe another unexpected result comes in the interplay. So we also asked experts outside the, say, investment game, how they actually think people do invest, right? So both financial professionals, so representatives of the industry, regulators, NGOs, and policymakers, and they systematically underestimate the demand for sustainable investments, right? And this is something that I think calls for future research, really to understand this better, how this misalignment of what people actually are doing and what the policymakers / people from the industry think they do, right? This wedge needs to be explained.
Yeah, thank you. And that kind of quite nicely leads on to my next question, which was for you, Johanna, on Oxford Economics kind of partnership in this project. So what did you find when you were looking into this?
Yes. So our main role in the project was to really combine the academic findings with the practical challenges of stakeholders in sustainable retail investment finance. So in other words, we really aimed to bridge the gap between the academic findings and their practical relevance and implications. And as a starting point, as we always do, we analyze the existing literature on the topic, and also we identify key stakeholders facilitating sustainable investments for retail investors in Germany. So what we did then to understand more about real world challenges, we conducted expert interviews with interviewees from banks, rating agencies, NGOs, customer protection organizations, and international institutions. That is, with all the relevant stakeholders that we identified during our desk research. And I think the interviews gathered some nice practical experience and standpoint on sustainable investments by retail investors, specifically for Germany, because we did it in Germany. And just to showcase one very practical finding that might, surprise policymakers, financial advisors in banks, for example, have to ask retail investors if they want to invest sustainably, as per the European Markets and Financial Instruments Directive 2. And if retail investors say they do not have any preferences for sustainable investments, they can choose any investment, and also the bank advisor can just suggest any investment, even sustainable ones. If they signal, so the customer signals to have preferences for sustainable investments, they automatically restrict the investment options and also the one for the financial advisor. So consequently, what the advisors told us or recommended their customers behind closed doors is to state they had no sustainable preferences. And this leaves them more options to offer all kinds of products. And this has very practical implications for the current regulatory environment, and also is maybe some part of the explanation why people in the industry underestimate the preferences for green investments if they, somehow, tend to, convince people not to state their preferences. And then just combining all these practical findings with the findings from Andre's group. And then we discussed them in 2 workshops with experts from the financial industry and academia. And then as a result, we drew conclusions of these combined findings for different stakeholder groups. And Andre already mentioned his 4 groups, which are more like really machine learning based and they are like clusters that we can find, and we just abstracted them a little bit more and say, okay, in the end, we have 3 different types of investors. The gray investors that tend to have a neutral or even hostile attitude towards sustainable investing. And these are like 15% of the people that we have looked at, just to give, how big is the group in the end. Then we have the light green investors. They prioritize returns, but are also interested in sustainability. So they may have the potential to be drawn towards sustainable investment, but their primary motivation remains financial. And this is more like the diversifier group that Andre talked about. And they are 58%, so the largest group that we could find. And then we have the dark green investors that have really green preferences, as we say. They are primarily concerned with the impact of their investments and are really willing to take on more risk to achieve that goal. And which is nice, while we not explicitly link that to the SFDR regulation, these type of investors align quite well with the different types of investments as per Article 6, 8, and 9 of the SFDR. So it's quite interesting that actually the regulation already somehow implemented that kind of different preferences. And then, of course, from that, you can say, what does that help us? So for gray investors, it's really unlikely that they contribute to sustainable financing solely due to their preferences for sustainability. But for the other 2 groups, of course, you can do something. And the largest group of retail investors, so the light green investors, they generally prioritize the returns, but are also interested in the sustainable options. But the complexity of the many definitions of sustainability, the range of products, and the diverse sustainability ratings can overwhelm them. So there's just a call for simplicity and clearer regulations for them. And conversely, the dark green investors, they are willing to engage with the complexity, and they really want to delve deeper into the specifics of sustainability just to make sure that the investments actually have impact. So then in the end, we really thought about what does that mean then for the sustainable retail community, because financial investors, the media, consumer organizations, and the government, of course, they all can have a crucial role in leveraging this knowledge to attract more retail investors for sustainable funds.
So that's all super interesting. And, you know, one of the things that I've come across is that just waterfall of information and ESG ratings, and it's really hard to understand what they all mean. I guess one of the things, so, I mean, we're recording this a week after the omnibus ruling kind of thing came out, which, as I understand it, is mostly on corporates, on sort of corporate sustainability reporting, but then that obviously flows on to finance. I think that's right. But you can correct me if I'm wrong. So what do our kind of, or your findings on this experiment mean for policymakers kind of in the context of that slight rollback on corporate sustainability reporting?
So I think first and foremost, it's really that the results indicate how regulations could be improved by following a more user-centric approach. So really looking at which type of investors do we want to tackle, which type of investors can we reach, and then, for example, for the largest group, as I said, the light green investors, it's important to inform about sustainability standards. So I think the EU taxonomy for sustainable activities is a first step in the right direction. But then again, there has been quite some discussion, especially in Germany, which parts are considered green investments, for example, nuclear energy and stuff like that. So it's just to make sure this is a type of green or sustainable investment. These are our minimum standards, and we just have to inform what's in there and what's not. So even if it's not the perfect definition for all these type of investments, I think for the light green ones, it just needs the tag sustainable. So here, just, you know, these standards and a clear taxonomy for sustainability ratings, this is just something that policy can support the light green investors to, you know, act or to invest more in sustainable funds. Just one addition, because Andre mentioned this greenwashing in the beginning. So I think it's also important to understand that if you provide these standards, that a lot of these light green investors, they somehow betray themselves. So it's also good to have some kind of minimum standard or a higher minimum standard, just to make sure that it's not a usual investment, but it's really a green investment. Because in the end, they are only interested in the tech, and they wouldn't really dig deep into the information, whether it's actually a green investment or not. So it's not the role of this retail investor to do that, but rather of the regulation itself. Then I think it's also something that government can just lead information campaigns to really enhance the investor trust, and also relieve the burden on financial advisors by just simplifying the sustainability landscape for both types of green investors. And then in the end, for the dark green investors, in the end, just products are missing, right? So there are not real impact investment opportunities for them. And while this is not the governmental role to come up with new products, it's still relevant to notice when communicating existing taxonomies or standards, right? So in conclusion, I think regulations can just help to make it clearer, simpler, and more credible for retail investors to sustainably invest if you understand their preferences a bit better.
Yeah, thank you. Well, hopefully this research contributes to that, and it sounds like it does. I think, Andre, a question for you on the takeaways side, and you touched on this before, but that, the industry doesn't necessarily have an accurate perception of retail investors' preferences. So what does that mean for retail investors, and why does that matter?
Yeah, no, I mean, it definitely matters. Just to combine this maybe with Johanna's last point, right? I mean, if we want to have, say, functional regulation, right? So that really, I mean, what's the idea should be that if individuals have certain type of preferences, they need to find the products they actually want to invest in, right? And there are, say, 2 or 3 very main important factors behind this. I would say the one is what Johanna was already referring to is, I mean, it has to be a clear-cut regulation, right? What we not want to have is basically still people try to fool themselves, telling them that they invest sustainably, but they rather just go for the highest return, right? And so the way I understand the regulation these days is that at least there is room for improvement, right? To do so. The second is what you were referring to is, do we actually see that the people who actually are responsible for the regulation / for the products, do they have the, say, correct understanding of the preferences of the individuals, right? And what I was already referring to a bit earlier is that what we see, not really, right? So what the experts actually tend to assume that most of the investors behave if they were behaving like maximizers, right? So they really go for the one with the highest return, right? So, but in reality, what we found is that especially these, say, advocates, right, they really are willing to invest sustainably, even if the returns are lower, right? And at the same time, and this is even, say, I would not say more worrying, but also a bit worrying, right, is that experts overestimate how much investors actually understand about sustainable finance, right? So they really think that people have roughly a good understanding, right? What we do not see across all of these investors. And this could lead, I'm not saying that it does, but it could lead to misguided product offerings, ineffective communication strategies by the regulator, and so on, right? And then as a final word on this, right? Why does this matter at all, right? And I would say, well, it matters because, say, if the financial institutions misunderstand the investors' preferences, they might actually not offer the right products, okay? And right products not meaning here that, say, return maximizing for the bank, right? But I think there's on both sides room for improvement. So to make the individual investor more happy and have the products better aligned with their true preferences, and thereby also being able to actually come up with products that right now do not really exist, right? So if banks, for example, right, might focus too much on this idea that we only talk about returns when we talk about sustainable products, then it may for some people actually be not that important at all, right? So what they really want, and I'm again not saying everyone, but this one portion of investors who really has this very strong preferences, they actually may be super willing to accept slightly lower returns. But one has to be open about this, I think.
And there has to be sufficiently, useful information for them to make those decisions well informed.
Yes, absolutely, absolutely. And it has to be, as Johanna was referring, right, it has to be a clear-cut information, right? These days, right, whether now it's about ESG standard, it's about SFDR regulation, whether it's about, say, the different EU alignment goals when it comes to the 2-degree goal, right? I mean, this is all so confusing, right, that on the one hand, I think it hinders individuals to invest sustainably, but on the other hand, it opens up a room to fool yourself that, I still invest sustainably, regardless that it's in the end maybe super non-sustainable, right?
Yeah, well, thank you so much for describing that experiment and those really useful insights, both of you. One final question from me, which is where can people find out more? And do they have to speak German to do so?
I mean, we have published the most in German, I have to be frank, but we have on the Oxford Economics site a translation of the project itself, and also a blog article that summarizes some of the findings. And Andre, I think you're working on the academic paper, which is probably in English, so people can wait for that.
No, absolutely. Right. So we will have, basically on my website, on the websites of other ones on the team, right? You're going to find our work, which is entirely written in English anyways. So very much looking forward to also talk about this.
Fantastic. Well, we will put those links to the German and the English sort of summaries in the show notes, so listeners can find out more if they so desire. Thank you so much, Johanna and Andre, for coming on the show today and sharing the results of this really interesting study.
Thank you.
Thank you for having us.
That's it for today on Greenomics from Oxford Economics. Tune in next time for a discussion on how supply chain risks can ripple through into financial markets. My team has actually just published an interesting research brief on this, and we'll also put that in the show notes, along with the links to Johanna and Andre's work. Thank you for joining us.